All right, my friends, so now it's going to get fun. Now we're going to talk about the Roth IRA and taxation and why you need to open one now. Oh, I can't wait. The last two videos we talked about the contributory aspect. You can actually access your cash that you put in there at any time without any reason on a contributory Roth IRA. The last video we just did, we talked about the difference between contributory IRAs and conversion IRAs and how the 5-year rule applies to conversions even if it doesn't apply to contributory when it comes time to access your the amount you put in, the taxes that the amount you paid in there. All right, so we look at those videos if you haven't seen those. Now we're going to talk about the tax consequence of the Roth and why you need to open this puppy ASAP to get started. So as always, if you like what you see, subscribe. There's a little red thing down there, a rectangle. My geometry is bad. It says subscribe. So if you haven't done that, what are you doing? It's free, this video content. So do that. And of course, don't forget to comment and thumbs up. Always helps me. Thumbs up with the algorithm. And of course, share the video. All right, so let's dive into this. It's going to be fun. We're going to use a single Sally. All right, so Sally is single Sally. And she's 50 years old, and she has $100,000 in her IRA or 401k. It frankly does not matter. All right, so Sally's got she's 50 years old, got $100,000 in her account. She is going to go forward and add I will just say, let's say $7,000 because that's what you can each year. She'll add $7,000 each year because she's over 50. She's over 49 years old. She's 50 years old or above, so she can put $7,000 in. All right, so you with me so far? Now, her plan is she wants to retire at 60. All right, so she wants to retire at 60 and just let the money grow until she's 70 for RMD. So just bear with me just a second. Don't ask or don't worry about where the money's going to come from when she's 60. We'll talk about that in other videos. But that's her plan. She wants to squirrel as much money as she can away, all right, till she's 60 years old at a crappy old job, and then she's going to retire, and then she'll sell her house and go to, I don't know, Costa Rica, something like that, whatever. It doesn't matter in this scenario. All right, so what happens then for old Sally if she gets $7,000 a year as her payment, and she gets 7% a year rate of return? How much will her amount be at 60 years old? And it'll be $300,000 even. Let me just make sure I got that right. $7,000 monthly payment, $100,000 is her present value. 7% for 10 years, $300,000. Okay, so when she is 60 years old, she's going to have $300,000 in this account. All right, you with me so far? But she don't want to touch it then. She wants to wait till she's 70 when the IRS starts mandating that. Now, in this case, we can easily say that the rule of 72, we know that will go to $600,000 by the time she's 70. All right, because rule of 72 is you just take your interest rate, how much you expect, divide by 72. In this case, she expects 7%, so I'll just draw it out for you. So you say 72, she expects she'll get 7% a year, and that means it'll grow at 10, that means the money will double in 10 years. Does that make sense? Rule of 72, how long for your money to double? So if she expects 7% a year, it'll double in 10 years. If she expects 10% a year, we can do this real quick, pretty interesting. 72, if she expects 10% a year, it'll double in 7.2%. 7.2 years, if that makes sense. That's the rule of 72. Very easy to use. Actually, I'm a huge fan of the rule of 72. That does not take into consideration further additions, because in this case, once she hits 60, she will make no more contributions, no more additions. So this just says she has $100,000 at 50. In a crappy old job, she's working another 10 years till she's 60. She's going to add $7,000 a year. There's a max she can do in her IRA, and when she's 60, she'll have $300,000 in that puppy. That will double because again, she expects to get 7% rate of return, and when she is 70 years old, she'll have $600,000 in her account. All right, so let's erase all this because we got a lot going on here, and I want to share with you what's happened now. So now Sally is 70. She's moving back from Costa Rica. She says, hey, Costa Rica is great. Single Sally. She's 70 and she has $600K in her IRA. And some of you have been following this channel know where this is going to go, but I will say this until I am literally in my grave and in my greater reward, because if you're not understanding how the tax consequences on your IRA work, you're making a big mistake. All right, so she's 60, she's 70 years old. She came back, and now she's living in, I don't know, Richmond, Virginia. And she has $600,000 in her IRA. All right, so what happens when she's 70? Well, she has required minimum distributions. So her first year distribution are going to be 27.4, 21, we'll just say 22,000. So she'll have RMDs, 22,000. All right? And for simplicity, we'll just say she has Social Security, I don't know, $2,500 a month, we'll say. So that's what, 30,000? All right. Do you know where we're going here, my friends? All right, so what we do here is we say, okay, Sally, you have Social Security of $2,500, and you have IRA RMDs of $22,000, $2,500 a month, and $22,000 for your required distribution. You're single, so what do we have to do? Well, we got to calculate taxes, and what we do is we say we have to take provisional income to find how much of this right here will be subject to taxes, all right? And what we do is we take 1/2 Social Security plus all other income. So in this case, it'll be 15,000 plus 22,000. All right? So her provisional income is going to be $37,000. You all see? Yeah, okay, good. So you with me so far? So we have to factor in what her provisional income is to get a gauge of how much of that $30,000 will be subject to taxation. All right, so what we do is we take, let's get a different pen here, is we know she's single, all right, so we take 0 to 25, none of that's taxed. 25 to 34 is $9,000, and half of that is taxed, so it equals $4,500. And then 37 minus 34 equals 3,000, and that's taxed at 0.85. And let me get my trusty calculator. 3,000 times 0.85 is 2,550 plus the 4,500 plus 4,500. That's 7,500. So 7,050, excuse me, of her Social Security benefit is subject to taxation. That's not so bad. So what we're going to do is we're going to say 7,550 of her Social Security benefit is subject to taxation. All right. Plus. All right. So what we do now, we have to figure out her AGI. AGI equals 7,050. My handwriting is not the best, my friends. I appreciate you hanging in there, because I'm just doing this as we're sitting here. All right, 7,050 of her Social Security is subject to taxation, plus this amount here, 22,000, which equals what? Well, it equals 29,050. All right. So her AGI is 29,050. Well, we're not done yet. We got to figure out her taxable income, and you take AGI. We're going to say minus 13,600 is her standard deduction. So she has I don't even know what that is. We'll just say 14,000, 15,000. Was that 250, 350? I'll get my trusty calculator again, which I left right here. All right, so we got 29,000, 29050 minus 13,600, 15,450. Oh boy, I'm glad I calculated that, or else people are like, you missed it. 14,050. And we know the first, basically 9,500 is subject to taxes, is at 10%. And then, what's that, $6,000 roughly at 12%. All right, so bear with me just a second. All right, so $6,000 at 12%. Oops. So her 720. So she'll have taxes of roughly $1,500. All right, so that's her taxes due to the state of to the feds and wherever she lives. I don't know. All right, but let's fast forward this a little. Let's add something here. All right, so you see how that works right there. That's from a traditional IRA. And I know you said, but Josh, we want to do a Roth, all right? Well, let me show you what happens instead. And this is just number one of the reason you want a Roth instead of the traditional. All right, so we're going to go back to the same thing. No RMD at all. No RMDs. But let's still say she wants that $22,000 of income. All right, so she has Social Security, $30,000, and she doesn't have RMDs, but we're going to say IRA Roth distributions, $22,000. You with me so far? So we have IRA distribution. In this case is coming from a Roth, $22,000, but it's not a required minimum distribution. It's not an RMD because there is none for a Roth IRA. And she has Social Security income of $30,000. So you ready for this now? This is where it gets exciting. I love this stuff. So now we got total $52,000 again of income. But we still got to figure out provisional income. How much of our Social Security will be subject to taxation if $22,000, if we have $52,000 of income? And again, we go to half our Social Security benefit plus all other income that's subject to tax. So taxable income or your tax-exempt interest. Notice the one thing that is not in here, Roth IRA. Roth IRA is not subject to taxable income and is not tax-exempt interest. Roth IRA is not included in determining what your provisional income, which determines how much of your taxes you have to pay on Social Security. So in this case, let's go back and get a different color. We have half of Social Security income, $15,000, and that's it. That's it. No other income in terms of determining your provisional income. Sally's single, so we know that 0 to $25,000 of provisional income is tax-free. She only has $15,000 provisional income, so the entirety of her Social Security, my friends, is tax-free. So now we figure out our AGI, and it's actually quite simple. Why? Watch. So we know none of her Social Security benefits taxable. None. All right, so if her AGI consists of 0, because none of that's taxable, we just figured out from the provisional income helps you determine how much of your Social Security's taxes. Her provisional income as a single taxpayer was below $25,000. That means none of her Social Security is subject to taxation. By the way, the Roth is not subject to taxation either. So if she has no AGI, she has no taxable income. None whatsoever. Not too shabby, huh? She saved $1,500 just this year alone in tax. And I know what people say, but how much did she have to pay in taxes when she did the Roth to begin with? Well, that's the that's the issue. How much did she have to pay in taxes in order to get the Roth going to begin with? But it doesn't just end here, and this is what we're going to do in the next video on this, on how much you saved in income tax on the front end versus how much you're paying in income tax on the back, or how much you paid in income tax on the front end versus how much you're saving on the back. There's more to that equation, which we'll do next here in just a second, in part 4 of why you need to open a Roth. Because this is just a tip of the iceberg, my friends. You know, you see those pictures, you got this tiny little iceberg up top, and you got this huge behemoth down below. This is what the tax code is when it comes to retirees. And I'm going to share with you here because she has $600,000 in her IRA. Ooh, it's going to get painful to watch as we go forward. Then we throw other sources of income in there too. It's going to get painful, my friends. So stay with me, and I'll show you what we're talking about when we go to part 4 of why you should open a Roth IRA. Thanks, guys.